Welcome, everyone. So right now, we are watching a massive paradox play out in the financial markets, and we're going to untangle the whole shebang today. Seriously, it's this crazy tug of war. On one side, extreme, unadulterated market euphoria. On the other, a really fragile economic reality. And sitting dead center in all of this chaos is the crypto market, flashing signals that have traders completely split. So the big question, are we on the launch pad of a brand new crypto bull market, or is this just a super aggressive bear bounce designed to trap the overly optimistic? Well, let's break it down in this explainer.
Okay, let's kick things off with this staggering number, 108%. That is the explosive one-month growth of AMD. In just 30 days, we watched an established legacy tech giant add massive, multi-billion-dollar valuations simply because AI hype is pushing tech stocks to absolute extremes. I mean, it's literally trading like a speculative microcap token right now, not a major semiconductor company. And you know what? This perfectly sets the stage for the bizarre market psychology we're navigating right now.
So here's our roadmap for the explainer to figure all this out. 1. The market paradox. 2. The illusion of the economy. 3. The case for the bulls. 4. The case for the bears. 5. The altcoin renaissance. And finally, 6. The verdict, bull or bounce. Let's get right into it.
Starting with Section 1, the market paradox, the unprecedented greed in traditional finance. We really have to look at the pure greed driving traditional markets today to understand crypto's current movements.
Seriously, when market veterans with 30 years of experience are coming out and saying they have literally never seen such aggressive, consecutive weekly climbs on the S&P 500, we need to pay attention. We're looking at 6 consecutive green weeks. And guys, these aren't small, hesitant little climbs. We're talking massive, vertical weekly candles without any of the standard market corrections you'd normally expect, even in a V-shaped recovery. Traditional markets are, for all intents and purposes, pricing in absolute perfection.
But that brilliantly illustrates our core paradox. There is this absolute disconnect between the euphoric reality of the stock market and the highly strained reality of the everyday economy. On Wall Street, the Nasdaq is just relentlessly smashing through resistance levels, totally fueled by AI exuberance. But over on Main Street, people are maxing out their credit limits just to maintain their standard of living while dealing with sticky inflation. It's truly a tale of two entirely different worlds.
Which brings us to Section 2, the illusion of the economy, cracks beneath the surface. Let's look at how the real-world data completely contradicts the market's current optimism.
Take a look at this jaw-dropping number, $1.28 trillion. That represents the record-high U.S. credit card debt as of late 2023. And hey, this isn't just an American issue. Over in Europe, places like Portugal are seeing consumer credit hit all-time highs too. Think about it. The everyday retail investors, the exact same people who usually fuel massive crypto bull runs, are taking on unprecedented levels of really expensive debt just to keep their heads above water.
So the market is pricing in this flawless future, but they're completely ignoring the massive macroeconomic cracks underneath. Inflation in both the US and Europe is actually creeping right back up. The US Home Builders ETF, it's trading completely sideways, which points to stagnant housing demand. Plus, we've got intense geopolitical volatility in the Middle East where, let's face it, a single news headline can swing oil prices 10%. And maybe most shockingly, the narrative is quietly shifting. The market isn't just talking about delayed interest rate cuts anymore. They're actually starting to price in potential rate hikes by the end of 2024. Moving right along to Section 3, the case for the bulls. Is crypto ready to run? Let's flip the script and see what the technicals are flashing for the optimists right now.
Because despite all that bad economic news we just covered, the charts are throwing off some undeniable signals. This side-by-side comparison directly pits the strong upward momentum signals against the lingering structural weaknesses. It maps out the battleground perfectly. If you're trading right now, you are staring at these conflicting columns, trying to figure out if the sheer momentum outweighs the structural risks. Let's look at the bull side first.
For the optimists out there, taking a long-term monthly view strips away all that daily noise and reveals some massive structural shifts. The monthly relative strength index, the RSI, is crossing above the 50 mark. Now, why is that a big deal? Well, historically, crossing that specific line has been the exact trigger for massive cycle runs back in 2015, 2019, and 2022. You pair that with the classic inverted hammer candlestick formation we just saw, which is a pattern that usually signals a major trend reversal from the bottom, and you can see exactly why the bulls feel they have a historically verified launch pad.
But hold on. Section 4.
The case for the bears, the threat of a dead cat bounce. Before we go declaring a new crypto season, we have to look at the heavy resistance staring us down.
The bears have some incredibly compelling counterarguments here. First off, an incredibly aggressive bounce is actually totally normal and mathematically expected after 5 straight months of dropping. Think of it like dropping a rubber ball off a skyscraper. The harder it falls, the higher that initial bounce is going to be. And since we're still trapped below the critical 10-period monthly moving average, this sudden pump might not be organic demand at all. It could just be a mechanical short squeeze. Basically, the market intentionally pumping to hunt down and liquidate short seller stop losses before it continues the downward trend.
To keep things completely objective, we map out what we call the neutral zone, right between $62,000 and $82,500. It is absolutely crucial to remove emotion from your analysis here. If Bitcoin is trading below 62K, the bears are firmly in control. But if we can cleanly break and hold above 82.5K, the bulls take the wheel. And anything chopping around inside that box, honestly, it's just market noise designed to shake out impatient traders.
Now this timeline right here is perhaps the most concerning piece of data for the bulls. History shows us that proper, sustainable market bottoms take hundreds of days to build a really solid foundation. Previous cycles took 287 days, 217 days, and 126 days to establish a base. Yet our current quote-unquote bottom formed in just 56 days. That is literally the fastest structural bottom in Bitcoin's entire history.
So, Section 5, the altcoin renaissance, FOMO versus reality. With Bitcoin seeing this extreme volatility, everybody is asking if altcoins are finally getting their moment in the sun. Well, let's separate the social media hype from the actual chart data. It's so easy to get caught up in the FOMO when you see a token like TON pump 90% in 3 days off blockchain validator news. But the broader reality paints a much darker picture. If you look at the Total 3 chart, which tracks the entire crypto market cap, excluding Bitcoin and Ethereum, it is fundamentally trapped in a classic bear flag pattern. What we are seeing are isolated, news-driven pumps, not a rising tide lifting all boats. And honestly, there's a strong case against an immediate alt season right now. It is incredibly difficult to launch a widespread altcoin rally when macroeconomic conditions are starving the market of oxygen. Like we talked about, everyday people are squeezed by inflation. They just don't have the speculative capital they had back in 2021. Meanwhile, the big institutional money is laser-focused on traditional AI stocks. To make it even tougher for altcoins, the Bitcoin dominance indicator is actually breaking upward, and the crucial Ethereum to Bitcoin ratio keeps failing to break that vital 0.19 resistance level. The capital just isn't flowing into the alt sector quite yet. All right, let's wrap this up. Section 6, verdict, bull or bounce, the final verdict. Bringing all this data together, what's the actual call?
Ultimately, the chart dictates the truth, not our personal feelings. There are 3 precise steps Bitcoin must take to prove this momentum isn't just a mirage. Step 1, it absolutely must hold $62,000 as a firm floor. Step 2, we need a definitive monthly close above $82,500 to confirm the bulls actually have power. And finally, Step 3, to completely invalidate the macro downtrend and officially declare a new bull market, Bitcoin must conquer that last major pivot point at $97,000. Until every single one of those steps is cleared, technically speaking, we are just experiencing a highly aggressive bounce.
So, as we wrap up this explainer, I want to leave you with one critical question to chew on as you watch the charts this week. Does a 56-day market bottom truly have enough structural foundation to push crypto to massive new all-time highs? Or is this euphoric financial market about to face a brutal collision with everyday economic reality? Keep your emotions in check, watch those key levels, and let the data guide your decisions. Thanks for joining me on this explainer.